Good day, everyone. Garrett Moore here. Lots going on in the markets, so I wanted to share a little update with everybody, along with a couple of ideas that might be prudent to consider. So let's jump right in. If you recall, at the beginning of this year, we shared in our client newsletter that the market was feeling a little frothy and that we might be due for a market correction, quite simply because trees cannot grow into the sky forever. We had two phenomenal years in 23 and 24, and it might simply be due time. And fast forward to today, and that's unfortunately exactly what we have seen. This is a really cool thing. It's called the Fear and Greed Index. Basically, it looks at a number of technical things that are going on in the markets to get a feel for how investors are feeling and kind of what they're doing in their portfolios. And then it aggregates all of that, kind of tells us, are people feeling fearful or are they feeling greedy? You can see that as of today, we are in a state of extreme fear. So if you too are sharing those sentiments, is perfectly understandable, and know that you are not alone. So let's talk about exactly why that is happening. So this is a chart of Nvidia. Nvidia is down 22% and change year to date. Tesla down 37% and change year to date. Finally, Google down 12% and change year to date. This is generally why I avoid investing in these individual stocks. It can be so tempting to jump into these things when they seem to simply be going up forever and just printing money. However, like we talked about in that same newsletter, you need to be prepared for the possibility of today's winners becoming tomorrow's losers. And that is pretty much what's happening here. Of course, these are the darling stocks of the stock market the past couple of years, propelling things higher in the aggregate. But when things sour, they tend to sour badly. This is why I far prefer diversified funds to at least blunt some of this pain. They are not going to be immune from this pain. Fluctuations are simply part of the market, but there's a lot to be said for diversification. It's something I try to preach and hammer home, and times like these are exactly why I do that. Okay, here's an interesting fact. Credit to Charlie Bolello of Creative Planning. He says the S&P 500 is down over 5% from its peak on February 19th, the largest pullback since last August. This is now the 30th correction of greater than 5% off a high since the March 2009 low. They all seemed like the end of the world at the time. Please pay attention to my emphasis there that this is the 30th time that we've seen a correction of greater than 5% since the 2009 low. These are common, they happen all the time, but when we are in the midst of one, it feels like the end of the world. Okay? This is an awesome chart. I will drop a link to it below so that you can download a larger version. This too was created by Charlie Bolello off that same exact fact. These are the last 30 some odd corrections of greater than 5% since 2009, with all of the various reasons as to why the market was declining over on the right side there. These are the headlines that dominate financial news at any given time. If you pull up CNBC or the Wall Street Journal, you will see reasons for this year's market correction, okay? The ironic part is that you have probably largely forgotten about all of the previous reasons that you're seeing on your screen. But like Charlie said, these felt like the end of the world when they were happening, much like today's decline. This year's decline can feel so powerful, like such a big deal. Um, the point being that if history is any indication, markets will prevail, the market will bounce back as it always has, and investors will be rewarded in the long term. Okay? Now, this is from Sir John Templeton, one of my favorite quotes. The four most expensive words in the English language are, "This time it's different." Of course, we are so very good as humans as coming up with reasons why this time is different and why the market isn't going to bounce back this time. Why this one is the big one, the apocalyptic one. The doomsday clock is finally reached midnight, right? Probably not. Okay. Sir John Templeton had been doing this long enough and was wise enough that he knew that probably wasn't the case. Sir John left us many years ago. Warren Buffett, obviously still around, and he shares this sentiment to this day, which is why I feel compelled and confident in sharing it with you again. Okay? Another wonderful quote by Morgan Housel: "All past declines look like an opportunity. All future declines look like a risk," right? So wouldn't we all love to go back to the lowest point of the great financial crisis when markets were trading at a tiny fraction of where they are now, right? And if we could only go back and just invest a little bit more, right, we would have been handsomely rewarded. But man, would that have been terrifying at the time, right? So a wonderful investing lesson there. All right, so what can we do about all this? What should we do? Number one, keep a war chest. A war chest simply being a portion of your portfolio that is invested in far more stable, far more safe investments. This is exceedingly important for clients that are nearing retirement or are in retirement. Obviously, you have living expenses that need to be covered. And ensuring that we have a portion of your portfolio in investments that aren't going to decline alongside the stock market means that we have a safe place to go to fund your retirement needs without being forced to sell low, and thereby giving your portfolio, your stocks, time to rebound over time, again, as they always have if history is any indication. Okay? Secondly, just give yourself permission to tune out the noise. Like I said, it is so easy to get caught up in the doomsday of whatever is going on at the time. They take over headlines, and man, it can be tempting to pull up your portfolio online or on your phone, and man, it can be a dooming cycle. So give yourself permission to just not participate. You don't have to check your portfolio every day, every week, or every month. Ironically, by extending that time period that you check in, you greatly increase the probability that you simply see your portfolio go up over time. And you're not stressing yourself out and driving yourself crazy by checking in on it every day when there's lots of volatility out there. Okay? Going back to those handful of stocks that have just gotten hammered this year, like I said, it's super enticing to jump in on those when the market is going up. But man, it's nice to avoid them when the market is going down. So it's so very important to stay consistently diversified. And then lastly, it is important to occasionally revisit your asset allocation. Your asset allocation is simply the mixture of your investments. How much are you going to devote to stocks that are likely to appreciate over time, but you're going to have to deal with some bumpiness on the way, compared to those more stable, safe investments? That ratio, that mixture, is the number one determinant of how your portfolio is going to behave. How much is it going to grow over time? And what kind of declines am I going to have to deal with when things get shaky? Striking that balance, something that's appropriate for you, is so very vital and something that's really important for us to hammer down. So if you feel like it's worth revisiting that today in light of everything that's going on, please know that I'm here for you. to discuss that. Don't hesitate to call. Use the link below to schedule some time. And that's really it. I appreciate your time today. Thank you so much. I'm here if you need me. Talk to you all soon. Bye-bye.